risk versus reward. And it's something that I talk to people about every day, right? You help people manage their money. You're always talking about what's the risk involved if you buy this investment, but what is the potential reward? And obviously, I guess all of us want the least amount of risk with the most amount of reward, right? That's how we all would love to see it. But unfortunately, the least risky things produce the lowest returns usually, and the more riskier side of things produce or can produce higher returns. But of course, they can also produce loss, unfortunately. So whenever you have risk versus reward, you obviously want to look at a number of things. And the first thing you want to look at is, what are your objectives? What do you want your money to do for you? What do you require or need from your investments? Do you need some sort of income? Do you need your investments to generate an income for you? A lot of people don't have pensions. They require or they need their portfolios when they retire to produce an income for them in retirement so they can live the life they want to live. So what are the investment objectives? And then, of course, what is your risk tolerance? What can you tolerate for risk? The first chart I wanted to show here, I think actually it's the only chart in this segment. Actually, no, there's two charts here. Is this real return of a GIC. I can't tell you how many people are asking me about GICs, short-term bonds, money markets, high-interest savings accounts, you name it. They're asking me a lot about this at this time because interest rates on, let's say, a one-year, let's call it money market fund, is now about 5%. If you go out maybe a year and a half, I've seen some 1 year or a year and a half GICs paying close or in and around 6%. Something that I haven't seen. Wow, I was back in 1999, I was selling 1 year GICs at 6.25%, interesting enough. And I haven't seen those kinds of rates since then. But this chart here on GICs, or real return of a GIC, clearly shows that if you want to take a GIC or money market fund or a high interest savings account, you can substitute all of them in this chart. And what you're going to notice is when you factor in inflation, and then when you factor in taxes, if it's not owned inside of a registered plan, real rate of return is significantly less. So here you have our chart. You look here, a 1 year GIC returns, and you can see on the far right, the return on a 1 year GIC has gone significantly higher. Difficult to see, but if you factor in your 1 year GIC after a 40% marginal tax rate, you'll notice that obviously the return is a little bit lower or a lot lower if you look at this chart. And then lastly, and probably the most pronounced line on this chart is the gold one, which says a 1 year GIC real rate of return after tax and inflation. When you factor that in, you'll notice that the real rate of a GIC is actually negative. You make, let's say, 5-6% on a GIC. Today, the inflation rate in Canada is 4%. You take away a bunch of that for taxes. Yeah, maybe you squeeze out a slight return, maybe 0.5%, but that just doesn't cut it if you're looking for growth in a portfolio. So what I always say is this: if you're looking to just get by, if growth is not important to you for your portfolio, yes, today you could buy a GIC, a low-risk bond, short-term bond, a money market fund, because your money can be, other than GICs, your money is liquid. You can get at these money market funds, high interest savings accounts whenever you need the money, and they're paying a 5% or close to a 5% rate of return. However, when you look at the S&P 500, as Brian mentioned earlier, S&P 500 right now is returning about 11% for the year, double what you're getting on these short-term instruments. So once again, are you looking for growth, or are you looking for low risk, just stay the status quo? And here you have a chart of the S&P 500, and you can see that, yes, there's an opportunity for loss, and the red are the years that the market or the S&P went down. This is a 30-year chart, by the way. You'll notice that in 2 years, the losses were minimal, and it's really only 6 years out of 30, the markets were actually down significant enough that it made a dent in people's portfolios. So what does that tell us? Well, more often than not, the stock market goes higher. The down markets tend to be shorter lived. The up markets tend to be longer. The down times sometimes are a little steeper than the up times. If you take away 2000 01 and 02, in that area to the left, you'll notice that really in the last 20, 23 years, there have only been 3 times the market's gone down in the last 20 years after we got through 2003. So investing in the market for potential reward is definitely there. And at the end of the day, what it comes down to, whether you invest in the markets or whether you take a lower risk approach, comes down to your risk tolerance and investment objectives. And when people ask me the question, Alan, what should I do? I will always turn it around and say, what do you want your money to do for you? And that will always dictate whether you should be in the market or should be out of the market in some interest-bearing investment.